an interesting interview with Mervyn King last night, the bank governor of the Bank of England, where he spoke about the country on the UK finances, the continued deficit that we are seeing at the moment. Indeed, we've seen publication this morning of the deficit for August, which came in at around £14.4 billion, a number that was greeted sort of reasonably favourably by markets. But what that number, or the underlying picture, tells you is that UK finances are worse than they were envisaged to be at the beginning of this year. And I think the intriguing point about all of this is that it's after the government has, to what I call, given it its best shot. They have come down hard on public spending, they have cut costs, they have raised taxes, they have done everything that they can in the early part of their government. But the thing that's not working for them is that the economy is not responding to growth. Clearly blame is being placed at the door of other international countries, and particularly Europe, that has held back the growth here in the UK. It doesn't really address some of the fundamental issues that we have here on a domestic front, but the reality is that despite giving it the best shot, the deficit is not coming down, and it comes at a point in the political cycle where do they sort of go for further cost cuts to try and sort of continue to address that balance, or do they get some support from the Bank of England? And indeed that's where that interview last night I think actually was quite interesting, because clearly it gives them the green light to some extent to break many of their own rules on the deficit situation, and indeed on their plan over 3 years to start to bring the overall debt position down. So that is a situation that is facing the UK. If we look at some charts around that, we can see that the UK gilt market has seen just in the course of the sort of September period a rise in yields. Now that has been more consistent with what we've seen in some of the higher quality fixed income markets such as Germany and the US. It reflects the fact that money has come off that real safe haven area of asset classes, which has been driven by QE, and moving into higher asset classes. So yields have started to move up on 10-year gilts. We have seen some weakness coming back into the market, so a little bit of tightening there, but as I say, largely absorbed. And the other area of sort of measure for the UK would be sterling, and money has continued to go back in sterling. This is against the dollar. I would say the picture is more of a picture of weakness in the US dollar rather than sterling strength, but this is over this period of time you've seen concerted action by the US central authorities to increase their commitment to the QE programme. And that, of course, has resulted in a weaker dollar, meaning that the sterling now is coming back up towards the very top end of the trading range that we've seen over the course of the last year. Now, reminder, we're at 162, 163 at the start of the financial crisis in 2007. We were at $2.10, so we've had a 25% or so correction over time. But as I say, sterling increasing at the moment is possibly not what the Bank of England would want to see as our export side of the business, which is showing some signs of life outside of the Eurozone. We wouldn't want that snuffed out too quickly. So back to the UK. I think that as the government is running out of options at the moment, it is going to fall more and more on the Bank of England to continue to support the economy. So we are hearing that whilst their commitment so far to QE is around about 375 billion, that another 50 billion or so could well be utilised in the fourth quarter of this year. Into Europe, well, the continued theme of lowering costs of Spanish debt has generally continued during the course of this week, not without its little ups and downs, which every time we do see a move up, it does scare investors. We do see some weakness in equity markets if we see that bond yield start up. But Spain this week completed an auction of 10-year paper, and markets were quite pleased with the result. Demand was up, yields were down compared to this time last year. And more importantly, Spain is now 82% through its funding requirement for 2012. Now, the big question that does hang over markets is this issue about whether Spain will come to us formally for a bailout and accept the conditions that poses. And the market's in a bit of a dichotomy over this whole issue, because of course if it has good news on its own funding ability, such as this week, does it reduce the chance of them actually coming for a bailout and therefore leave Europe continually exposed to these issues? To some extent you need yields to sort of rise significantly in order to scare Spain into accepting the bailout and then reducing it. So it means that this particular situation around Spain, I suspect over the next few years will continue to keep markets on more of a sort of volatile path compared to before. Other issues for this week, I thought it worth mentioning Japan. The Nikkei has moved higher. That we have had these concerns about Japanese relationships with China this week, but it hasn't impacted much on equity markets in Japan. So being largely absorbed at the moment. So I continue to see the trend moving higher. Money still continuing to find its way into Asia at the moment, where the demographics are still seen as much better to equity investors, and particularly as this old adage of how reliant they become on Western demand and how vulnerable they could become if we were to see the West go into another recession. I think the argument is going that they've got themselves on a much firmer footing to find themselves resilient to that. Just ready to finish off, 3 equities that are catching my attention at the moment. ITV, an organisation that the general perception is that ITV is clearly losing the battle to other forms of media and technology. Well, their share price has just hit a 12-month high, so they're clearly doing something right there at the moment. Content clearly remains key. They have content within their organisation which will be valuable to other media owners, and they're also party to the launch of the new YouView, which is the BT-led offering, which is for films and television on demand. So just interesting that they're breaking out into new high territory. Man Group has had a horrific couple of years, as its core trend-following fund, the AHL fund, has failed to perform, and they have seen deposits move out of Man Group. But signs of life coming back into Man share price recently, as we're starting to see more trends develop into financial markets. The hope is that AHL could see better performance out of its hedge fund, and that in turn would make that equity quite operationally geared towards any move on that front. So it's a high-yielding stock, certainly has to be classified in the high-risk category, but the shares are beginning to move up on that. And there was also some mutterings of bid talk from the US, which I don't think has come to much, but it's all causing a bit of interest in that stock. And the final one, which is causing me some interest at the moment, would be in the mining sector. I do think the miners are the place to look for activity at the moment, and as you can see from the chart of Rio Tinto, we've seen lots of big swings in movements of that stock. Hit a high of 33, back down to sort of close to 30. Certainly one that we would continue to have a longer term play. We've got a mining note on that. Do ask your broker for a copy of that.